Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Jay Heller, Head of Capital Markets at Nasdaq, Maddie Radner, Director on the Nasdaq Market Intelligence Desk, and Marc Jaffe, Managing Partner at Latham Watkins New York office, which is celebrating 40 years in New York this year. And we're here to discuss the IPO pipeline, best practices as a public company, and pre-IPO financing solutions. For context, Latham Watkins is ranked the #1 IPO firm in 2024, according to Deal Point data. It is great to have all of you with us. Marc, congratulations on the anniversary, the #1 spot. Obvious question, state of the IPO market. Feels like it's slower, but the stats don't look too bad once you read between the lines.
Yeah, I would say the state of the market is anticipating. And I say that because the pipeline is fantastic. Maybe the best pipeline of companies that are in registration, ready to go to registration, that I've seen in my 30-year career. But there is an unsettled market. Trade issues, tariffs, global uncertainties is keeping people on the sideline today. When we see some stability, I think the deals coming to market will be big. There'll be brand names. There'll be exciting technologies. And I think we'll all be incredibly busy. But today we're anticipating.
All right. Well, Jay, do you think it's a function of because the market is uncertain that we have a robust pipeline, or would it have been robust regardless?
It's a great question. I think it's a little bit of everything. I think ultimately the stage in which we're at, if you kind of look at where we were in 2021, it was so robust. We had just at Nasdaq 752 IPOs. There was over 1,000 in the US alone. And then we kind of got knocked down, and then we're kind of picking ourselves back up. And so if we were walking, or crawling, I should say, and then we started to walk, it feels like we're between a walk and a little bit of a jog. So there's always been companies that need to access the capital markets, but the debt markets and private markets are so robust as well. You can dual track, you can access the capital in which you need. But I think to Marc's point, I've never seen a deeper pipeline, and I've been doing this for 25 years as well.
Well, that is exciting. And Maddie, in terms of healthcare, I know we talk about that a lot. Is that a big component of what you're seeing in the pipeline?
Yeah, so far this year, there's been 65 total IPOs across the US exchanges, including 16 SPAC IPOs and 49 operating companies. We have seen 12 healthcare IPOs so far this year, with 30 still on file. That, again, compared to 2021, there were 164 healthcare companies that went public on a US exchange. As rates went up, we saw 26 in 2023. And last year, we did see healthcare companies come to market. We started to see them come back. So there were 43. So 12 so far this year is pretty good. We're seeing companies with a clear path to profitability take advantage of the lower cost of capital.
Well, Marc, let's talk about that some more. I mean, what was it, 752 names that we brought public just alone in 2021 at Nasdaq? That was some fun times at Market Site. What type of companies should be coming to market? Growth at all costs, and just because you're a unicorn status doesn't necessarily mean you're going to be successful post-IPO. Are investors more discerning about the types of companies and how they're managed coming to market this time?
Yeah, another great question, and I like Maddie's optimism. We are up year over year from last year, so I should have been more upbeat about the state of the markets. I think people came in to 2025 expecting the floodgates to be open. Right. They're not open, but I forget what Jay said. We're not crawling and not quite running yet. Who is going to come out first? Who is going to be successful? I think brand names are important. I think brand names with known products are going to easily access the capital markets. I think bigger ticket IPOs are going to be big winners when the market opens up a little bit more. And life science is Maddie's right, is a great place because they constantly need capital. They use the equity capital markets as their financing source. And there's great technology and great science who the market is willing to put money behind. It is not, those IPOs are not multi-billion-dollar transactions. Plenty of money in the $100 million range to finance these great companies.
Well, Jay had mentioned that there's more ways to finance companies prior to going public. You have more bespoke financing options, more complex, if you will, and these are all for the pre-IPO companies, which is why we're seeing companies stay private longer. Is that a trend that you expect to continue, and how is that impacting IPO activity?
Another great question. It's like you prepared for this, this talk. The private financing options are myriad. These were not options that were palatable or even available 3, 4, 5 years ago. And today, whether it's debt, which has a coupon and has leverage issues, or it's equity, which can be dilutive, or frankly, hybrid capital, which is somewhere in between and you get the best of both worlds, those options are available in abundance. They're available to smaller startups. They're available to bigger ticket, already unicorn status companies. The sources of financing are there. They're ready to deploy. I think companies need to be opportunistic. They need to work with advisors that are able to help them sort through really the myriad of options and think about what's best for the company's cap table over the next 3, 4, 5 years. The opportunities are there, and not every company is going to go public right away.
Yeah. Oh, so Jay, let's discuss that. Not only do you open up Nasdaq stocks here for their first trade, when you're speaking with companies in preparation for their IPO, what are some best practices? What are some common concerns that you hear about? How are you advising them?
So I think the first thing is the pathway to being public. It's a lot longer now, right? It used to be org up, 6, 7 months, we're ready to go, get your registration statement in, hire your attorneys, put the syndicate together, and let's go to the exchange. Now, because we've been through 22, 23, 24, there's more time to tell your story. So whether it's going to be a TTW or you're calling it an NDR, non-deal roadshow, companies are now taking 6 months, 12 months, 18 months, and they're going out and they're really kind of communicating. So what I say, if you have the 4 C's when you buy a diamond, when a company's going public, you got the 3 C's. Your message has to be clear, concise, and compact. Here's who we are, here's what we're going to solve, and get straight to the point. You're getting one shot to tell your story. And there's a lot that are sitting kind of behind the scenes just waiting. Healthcare, biotech, these are different companies than 2021 and before. These are stage 2, phase 2 and beyond, closer to commercialization. They are ripe for either the public markets as an IPO and or M&A. And then when we talk about some of the names, they've had a lot of time to craft their message and get in front of investors. Make no mistake about it, investors from the buy side institutions, they are there. But difference is, will they pay up like they have in the past? And that's still TBD. So we're waiting, we're optimistic. I think ultimately, it's a matter of not if, but when. And it's coming, I just can't tell you exactly when.
You know what though, Marc? I think sometimes if you stay private longer and you have the opportunity to apply more appropriate governance and really understand your business. It's one thing to have a great calm story. It's one thing to be able to execute and operate. So perhaps from that perspective, companies just aren't ready to go yet and they need more time.
Yeah, Jay is right. The race to go public, which could have been, you could have reached the finish line in 5, 6 months. Really well-managed companies are taking 18 months, 24 months, and are thinking through not just good governance, and a lot of the companies that we're talking about that stay private longer operate like a public company with boards of directors and independent members and real audit rigor. But in addition, I think the biggest trick to being a great public company is marrying ops and forecasting, really knowing how to model out earnings, really knowing how to deliver on what are promises to the market. It's a lot easier when you're practicing in front of a private audience than it is for a public audience. And I think companies are taking great advantage of that time.
Right, because that's a big variable. When you have to report and you have to be able to deliver to shareholders and have those conversations, that's a little bit different than it is when you have your first round of investors. It's a totally different conversation. You're expected, you have a fiduciary role now, with your investors.
And even crossover investors are big, sophisticated institutions that are, I think, a lot more patient than the public markets. And that ability to practice with people who are investing for growth, who are investing because they believe is a great way to practice for a more fickle public market.
Yeah, well, I mean, well, it makes sense, Maddie, right? I mean, institutional investors, they have a different mindset, they have more capital, they have the time to wait. That's the risk versus reward scenario there. But when you think about the public markets, even over the past 5 years, there's that rush for immediacy. And being patient's not a characteristic that exists as much as it does in the private market.
Yeah, and something that we are noticing, at least in the pipeline, is the interest in non-US domiciled companies to list here in the US. On file, obviously, it doesn't include some of the higher profile names who haven't filed yet. 70% of the operating companies who are on file are actually based outside of the US. So they are looking to take advantage of some of the opportunities to list here in the US. Maybe that's a different pool of investors who they may not have on a global exchange, more trading volume, and obviously access to Nasdaq's and other IR suites and different visibility opportunities here.
Yeah, well, which is interesting because if you put on your legal hat for a moment here, companies preparing to go public in areas like AI, which I'm sure is deep in the pipeline, the evolving state of regulations and laws being formulated around AI, they're constantly changing. Here in the U.S., we're starting to figure out that framework. What does it look like? How do we operate? And then, of course, adhering to EU laws is a whole other story. I wonder if that influences the decision as well.
It does. I want to echo something Maddie said. I mean, these are the deepest, most liquid capital markets in the world. There are great markets in Europe and in Asia, but there is nothing that comes even close to the availability of capital that you find in the U.S. So it's not surprising to me that so many foreign private issuers are coming to the U.S. And regulation is the reality wherever you are.
Right.
And I think being thoughtful about being nimble, particularly in an area like AI, which is so fluid at the moment, being able to be nimble is critical. Sitting on the sidelines may not be the best opportunity when the capital is available, but jumping in and being nimble with respect to regulation is probably critical.
Yeah, I mean, and Jay, I feel like the term AI is so broad. So it also depends what subsector you're in or how you're using it. Sometimes companies fall into the trap where they're delivering a product for the sake of, to say that they have, AI. But at the end of the day, it's the return that matters and having a problem that needs to be solved. And I think investors are discerning about that.
Right, it brings efficiency, and AI is still evolving in itself. And so the one thing I would say, and to what Maddie said and what Marc said, a lot of the companies that are overseas, they've operated in their region, and they never knew that there was a direct pathway to the US. They always thought, we're not good enough, we're not big enough. And as teams at Latham, and obviously our teams here at Nasdaq, we're spending more time educating, spending the time with corporates from around the world. You show them that there is a pathway, and then it's ultimately, do I want to be dual listed? Do I want to be primary listed here in the US? And so ultimately, the markets are open. You're getting access to amazing companies from all over the world, for that matter, that now think, to Marc's point, the US does have the deepest pool of liquidity. Can I get there? And the answer is maybe. So that's where a lot of the optimism comes in across the board.
You said you could be dual listed or this could be your primary market. Is there a benefit to one or the other?
Truly depends. I mean, what's your affinity to the home country? I mean, for us, we just want to see more great companies regardless of where they are and what they do. We want them to be here to have access to not only the U.S. capital markets, but for their investors to have liquidity. So I don't think there's...
But wouldn't they have it either way, right? You could be listed in Singapore and then also dual listed in the U.S.
You could, but then if you're still listed in Singapore, are you going to have the liquidity that you may find here in turn in the U.S.? So it's a matter of, can I access the investors from ultimately all those regions specifically? Maybe you don't want to have to deal with, overnight trading, which is coming, right? 24/5 is coming, and maybe that's for the next session. But there's a lot of excitement within the markets and the capital market formation in itself, and from the geography of where these corporates are listed. AI is today, and it's hot. I mean, we at Nasdaq, we spend a lot of time and capital, really finding out what can be next and how we're going to make our lives more efficient. But there'll be something next in the future as well.
Jay, to amplify your point, in 20 and 21, I don't know if you remember, but every retailer of fast fashion said they were a technology company.
Yeah.
Yes, or blockchain, they were attaching blockchain to their...
Because they had a website.
That's right.
And
That's right.
today, every retailer of women's fast fashion is AI driven.
AI.
So Jay's right.
Yeah. I think it's also important to know, as you're thinking about your strategies for going public, it's not a one-size-fits-all solution. It's not like this all goes into some sort of black box. And to Jay's point earlier, in terms of how you want to source liquidity and dual list and so forth, there are different reasons for different types of organizations. It's not, here's a list, now go public.
Yeah, no, exactly. And I think because we spoke earlier of the variety of capital available to companies who are in a growth period, because they have the opportunity to list in the United States, to raise capital locally, good brands, good technology, great companies are going to find great investors, and ultimately, the best of those companies end up trading in the United States.
Yeah, well, it seems as if the macro environment, once you hear about how the fundamentals are lined up for many of these companies and how robust the pipeline is, maybe it's not so dependent on what's happening, in the macro space. I feel like we need to get one out the door, Jay, right? And if it performs well, a larger one, and that's the benchmark for other people looking to go public.
People are looking for a reason to get really excited.
Mm-hmm.
Right.
But from the investor standpoint, let's not be disingenuous, nobody is in the market to lose money. People want to know that if they deploy capital into anything, whether it's widgets or it's AI or whether it's going to be farmland, they want to know that over the period of time, I am going to have a return on my investment. When you look at what's taking place with interest rates, when interest rates are higher, and historically speaking, the equity market gets you 10 to 12%, the delta between having a safe investment versus the equity market, it's not as robust. As interest rates come down and companies continue to grow, and as an investor, I feel that I'm going to get a better delta in the equity market, which historically you will. That's what gets people really, really excited for what can be in the future.
Yeah. What about part of 2021 was a lot of SPACs. Do you think that will be a trend that continues, or are companies leaning towards going the more traditional IPO route?
Yeah, whenever I guess the future, I get it wrong. Every time. But I think the traditional IPO route is going to be the more prevalent route.
Yeah.
I think staying private longer is going to be a trend. I don't think the SPAC market is going to see the froth that it saw.
I mean, you also have a lot of investor demand for the derivative products that come off of these private investments as well, right? Like private credit is an example. So, if that demand is there, they'll find ways to deliver from that.
Yeah, absolutely. And I would just say another trend is, we have private equity firms with great portfolio companies that have raised continuation funds that have been holding assets longer. I think that is going to be part of the impetus, part of the feeder for a more active U.S. public market.
Well, they have to do something with the capital.
Yep.
Look, if you're an LP for a GP, right, you want a distribution. And if I'm the GP, if I'm the private equity fund, and I'm going to raise another fund to deploy new capital, as an investor, as an LP, I do want some kind of distribution. So it's what makes the world go round and round. There is a lot, as Marc said, there is a lot of private equity portfolio companies that we believe will probably tap the public markets, but everybody's dual pathing, and there's a dual track. But the IPO market, make no mistake about it, being public is very powerful. Liquidity allows you for M&A. It allows employees and early investors. Your children are getting married. You want to buy a house. You want to buy a car. Whatever it is, choose the pathway that makes sense for you. Look, Maddie said there's 16 SPACs this year that took place. And I do think there's going to be some more. So for just figure out what works best for you. But the biggest thing that I always say is protect the house. Choose the right investors. Make sure that if this is going to be the path, you have to engage with people like Marc and his team, your banking syndicate. You have to ensure that you're going to protect yourself, because look, when you're public, it's a different world. And we're going to be here to support you along the way, but we really want to see more companies public.
Yeah.
And Jay, you didn't mention, but I'll mention it for you.
Thanks.
The branding and the validity that comes along with being listed on Nasdaq means something to an operating business.
Yeah. Well, plus you get direct access to Maddie, to Jay. I mean, they're talking to our Nasdaq listed companies all day long. So, you get direct corporate access to the horse's mouth, and whatever that expression is. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.